Hey there, my future CMAs. Welcome back. I am so incredibly pumped to be here with you today for this explainer. Look, if you're gearing up for part 2 of this CMA exam, you already know exactly how critical Section A is. So let's just jump right into it. Up until now, in our study of financial statement analysis, we've honestly spent a lot of time evaluating ratios that are built entirely on internal accounting numbers. You know, things like how much cash we have on hand, how fast our inventory turns over, what our profit margins look like. But Today, we are going to bridge the gap between our internal accounting records and the outside world by looking at market ratios. This is the moment where your hard work on the inside gets judged by the outside.
Here is our step-by-step roadmap for today. 1. Internal data to Wall Street. 2. Foundation, EPS and book value. 3. Market valuation multiples explained. 4. Investor returns, yield versus payout. And finally, 5. 4 golden exam rules.
All right, part 1. Internal data to Wall Street.
Making this big mental shift to market ratios really comes down to answering one fundamental question. How does Wall Street evaluate our current performance and our future growth prospects? You see, the ICMA tests these concepts heavily because they want to know, for sure, that you understand how your internal corporate strategy actually translates into shareholder value. It's not just about balancing the books anymore, right? It's about understanding how the public market perceives the value you're creating. And I promise you, by the end of this explainer, you're going to feel completely confident interpreting these signals and knocking these exam questions out of the park.
Moving right along to part 2, foundation, EPS, and book value. So before we can ever start calculating market valuation multiples, we have to know what one single share of stock is actually worth on paper, at least according to our own accountants. And that starts with our fundamental building block, basic earnings per share, or EPS. Step 1 is to take your net income and subtract preferred dividends. Step 2, you divide that result by your weighted average shares outstanding. Now listen closely to step 1, because this is crucial CMA trap number 1. Just like we see in return on equity calculations, you absolutely must subtract preferred dividends from net income. Why? Because EPS measures earnings available only to common shareholders. Preferred dividends, well, they have priority. They have to be paid first before the common shareholders ever get to see a single penny. Now, I want you to really think about the contrast in the denominators between these two foundational metrics. Basic EPS uses the weighted average number of shares outstanding over the entire period, but book value per share, which is our net historical cost figure, uses ending common shares. This is such a brilliant illustration of a core accounting concept. Think about it. Net income for EPS is generated over a flow of time, right? Like a whole year. So we need an average share count. But book value, that's pulled from the balance sheet, which is just a single snapshot taken at midnight on the last day of the period. So naturally, we use the exact share count at that specific moment.
Okay, part 3, market valuation multiples explained.
Now that we've got our per-share foundational metrics locked in, let's compare those paper numbers to the actual market price traded out there on the stock exchange. First up is arguably the single most famous ratio in all of finance, the price to earnings, or PE ratio. The formula is beautifully simple. You take the market price per share, literally whatever the stock is trading for right now on Wall Street, and you divide it by the earnings per share we just calculated. But what does that actually tell us?
Let's make this concrete with a quick example. Say a stock is currently selling for $30 a share on the market, and its EPS is $2. Well, 30 divided by 2 gives us a PE ratio of 15. This number means absolutely everything to Wall Street. It means that investors are literally willing to reach into their pockets and pay $15 today for every $1 of current earnings that the company generates.
But you gotta wonder, why on earth would someone pay $15 or $50 or even $100 for just $1 of earnings? Well, this is where market expectations come in. A high PE ratio is essentially a massive vote of confidence. It signals that investors expect incredibly strong future earnings growth, or they think the company is exceptionally low risk. They're happily paying a premium right now for profits that haven't even happened yet. On the flip side, a low PE ratio might mean you've stumbled upon a hidden gem, a company totally undervalued by the market. Or, and this is the more pessimistic view, it signals that investors fully expect the company's earnings to take a significant nosedive in the near future. Next up, we have the market-to-book ratio, which you'll also hear called the price-to-book or P/B ratio. Here, you take that exact same market price per share, but this time you divide it by the book value per share. For most healthy, growing companies, you're going to find that this ratio is usually much greater than 1.0,
What that means is the market thinks the company is worth far more than what the historical accounting records say it's worth.
So why the huge discrepancy? Well, historical accounting has incredibly strict rules. Your balance sheet simply doesn't capture the immense value of fierce brand loyalty or proprietary internal software, the potential of a pending patent, or even the sheer genius of your human capital. Why? Because accountants generally ignore things they can't slap a firm physical price tag on. But the market price? The market price factors all of that invisible value in. And that's exactly why the market-to-book ratio is such a fantastic indicator of how much value management has managed to create above and beyond just the raw physical assets.
Section 4. Investor returns, yield versus payout.
So investors basically earn returns in two ways. There are capital gains, which just means the stock price goes up, and then there are cash dividends, which is actual cold hard cash deposited right into their brokerage accounts. On the CMA exam, you absolutely must know how to distinguish between these two cash metrics. They sound really similar, but they measure completely different things. First is dividend yield. This answers the question, what cash return am I getting relative to the current stock price? You calculate it by taking the dividends per share and dividing by the market price. The second metric is dividend payout. This answers a totally different question. What percentage of our annual net income are we actually paying out to owners versus keeping for ourselves to reinvest? And you calculate this one by dividing total dividends by net income. Let's look at how this actually plays out in the real world when it comes to corporate strategy. Imagine a really mature, highly regulated utility company. As you'd expect, they might distribute 70% or even 80% of their net income straight to shareholders, leaving maybe only 30% to be reinvested. Why? Well, a mature utility company doesn't need to go out and build 1,000 new power plants every single year. Their growth is steady, it's slow, so they reward their income-seeking investors like retirees by distributing the vast majority of their net income as cash dividends. Now contrast that mature utility with a young, aggressive tech startup out in Silicon Valley. Their dividend payout ratio is almost always going to be exactly 0%. And listen, a 0% payout ratio isn't a sign of failure for a startup at all. It's a strategic necessity. They are taking every single dollar of net income, assuming they even have net income yet, and fiercely reinvesting it straight back into research, development, and market expansion. Their investors aren't sitting around looking for a yield today. They are banking on a massive capital gain tomorrow. And finally, Part 5, 4 golden exam rules. We've covered a ton of ground today, so here is your ultimate mental checklist for exam day. Rule 1. Always, and I mean always, subtract preferred dividends from net income when you are calculating basic EPS and the dividend payout ratio. Rule 2. Keep the flow of time versus the snapshot in your head. EPS uses weighted average shares in the denominator, while book value per share uses ending shares. Rule 3. Don't let the exam trick you with similar-sounding names. Dividend yield uses market price in the denominator, but dividend payout uses net income. And Rule 4, remember the market's psychology. A high PE ratio reflects market expectations of future growth, not necessarily current profitability. I want to leave you with a bit of a provocative question to ponder as we wrap up this session. If a company's PE ratio suddenly doubles, literally overnight, but their actual earnings haven't changed one single bit, what did the market just decide about its future? Just think about the massive expectations that must have shifted to cause that kind of spike in price. You guys are doing amazing work. I know studying for the CMA exam is a tough marathon, but every single concept you master here is moving you one step closer to that certification. Keep this incredible momentum going, go tackle some practice questions right now while the formulas are fresh in your head, and I will see you in our next explainer.